Wednesday, July 27th. I'm going to call the meeting to order. I'm going to start with attendance. Neil, if you can just say your name and move along. We'll go from right to left.
Trustee.
Jason Tice.
Dave Olson.
Dave Petoskey.
Brian Keeps.
Danny Walsh.
Chris Kalinsky.
Okay, we have a quorum. So I'd like to start with public comment. Is there any public comment?
Good morning, everyone. My name is Mark Intockley. I reside at 1550 Georgetown in Bloomfield Township. About a year ago, I came in and I discussed, we have multiple accounts, OPEB and the defined benefit account. They're all funded at different levels. And one of the unique things about the OPEB account with the smaller accounts, we have an ability to see how the actuaries and contributions impact funding and impact township finances. Recently, the township has continued to make contributions to those funds based on the value of the benefits, even though some of them are fully funded. So it's difficult for you guys to assess what the township needs moving forward or future expectations when you don't have real data to look at, are the actuaries working properly? Because a big portion of where do we need to put money and how much? One of the things we've seen on the OPEB side when the township removed public safety was a majority of the contributions made over the last 2 years were not based on a pro rata liability between public safety and the other township fund liabilities. And when it was removed, even though the liabilities were at a 74-26 split, the assets were at a 54% for the public safety and 46 for the remaining portion of the township, which and we're looking now at a 0.6 millage increase for public safety. And I'm wondering what information Jason's receiving for him to make these recommendations to the board during budget meetings. The same thing would apply in what we see now with the drop in the markets. We can't prevent the markets from dropping, it's just reality. But as we move forward, how much does the township actually need in future actuarials? Because what we're looking at is a drop right now to about 86% or so on the, and we're not tracking that either. We can go back to the actuaries, look at where they expect us to be going through the year. Even if it's linear, it gives a good idea from a planning perspective, especially since Ms. Walsh wants to put together a 10-year plan, financial plan for the township. Again, I noticed Nikki Haley wasn't interrupted when she spoke on Monday. So anyways, that's my concern moving forward, how much funds are actually going to be needed moving forward and how it will impact the budget. Thank you.
Any other public comment? Hearing none, I'd like to go to item number 3, approval of minutes from 4/27/22. I get a motion?
Motion. Second.
Second. All in favor?
Aye.
Aye. Any nays? Hearing none, those are approved. I'd like to turn it over to Brian for a moment for an update on a report.
Okay, so these are our our township reserves that I'm going to be speaking about. We have our Oakland County pool, which we have roughly $42.7 million in as of 6/30. That fund at this point is yielding about 0.6% return. We are looking at alternate ways to keep this portion of our reserve. That is, currently that portfolio lags the aggressive growth in the short-term rates. So as that was starting to begin, we started to put more into our UST bills. We have gone from, at this point, 17.9 million on 6/30. We added another 6 million into short-term T-bills. Our portfolio is anywhere, it's a .79 duration, so it's very short term. Our rates are anywhere from 1% to 3%. Again, these are all U.S. short-term Treasury bills. Our average return right now in that is almost 2.1%. Again, we're continuing to focus on how to redeploy, reinvest that 42.7 million until that fund gets closer to market. Their maturity is 536 days, so their legacy investments, so to speak, are still out there. So I think it's going to be a little time before that return starts to tick up. And I think, as everyone has seen, short-term interest rates have increased significantly in the last quarter. So we're continuing to press upon that and looking forward to some good returns. One of our concerns is, because these are mark-to-market at year-end, at our fiscal year-end, we don't, on one hand, want to have any significant market alterations. However, we are looking at, or markdowns. However, we do hold these to maturity. So if we have an upside, then we have a downside. They really do even out over over 2 fiscal years. Nonetheless, it does kind of show an aberration at year end that we're trying not to get into. However, with the ladder that we're trying to build, we don't want to get too much into concerns of mark to market, again, because we are holding these to maturity. So at the end of the day, it evens out. So that's the update. Any questions?
Okay. Item number 4 is the quarterly summary. I'll turn it over to Brian Green.
We'll start with a bit of a story. I promised I would change my comments from retiree healthcare to FSC. So my wife and I, my sister introduced the idea, but my wife and I, so I've got an 8, 7, and 3-year-old at home, and we play this game on a weekly basis called Parenting Bingo, and it's basically checking off crazy things that you're like, well, I didn't expect this to happen, but it did. And I got to check off the box of 7-year-old with a broken arm, fell off the swing sets at the neighbor's house last week. So to that end, I've learned as a parent, there's 2 types of people in the world. Like, there's Band-Aid rippers, and then there's those that slowly take it off, and I've become a Band-Aid ripper because it's just easier. So to that end, look, as we talk about things for second quarter of 22, talk about things from a calendar year-to-date basis, there's nowhere to hide, right? From a traditional equity, fixed income standpoint, your question was, was I down 10 or worse? And when you say down 10 or worse, you think from an equity portfolio, and I'm saying no. From a high-quality U.S. fixed income portfolio, you were down 10% or worse for the year. From an equity market standpoint, you were down 17% or worse, depending on where you were. So if the thought was, well, my stock portfolio didn't hold up too well, just given negative news from an inflationary standpoint, concerns of a recession, concerns of continued rising interest rates, concerns of the consumer being tapped out, right? Negative headline after negative headline after negative headline. Well, hey, if my stock portfolio didn't hold up too well, my bond portfolio probably did, except you had a 1/4 point rate hike in March, a 1/2 point rate hike in May, 3/4 point hike in June, and probably 3/4 to a full point hike here this afternoon. So this afternoon will be a telling story, not just in terms of what that hike is, but more importantly, the commentary coming from Powell and some of the other Fed chairs, just in terms of what they see and where things are going. The other piece that's happened here in the last week is there's kind of become a bit of a bifurcation of kind of the forward-looking outlook in terms of where rates are going. And there are now those firmly in the camp of, by summer of next year, we're going to be in the 3.5% range for short-term interest rates. And there are those now in the last week where I've seen they think we're going to be in the 1.5% range, which is interesting because that means we're going from tightening to easing in a pretty short period of time. So time will tell on that. time meaning sometime in the next 4 to 6 hours and sometime in the next 4 to 6 years. I'll give you as wide of a window as possible. The other piece that I leave you with, and you think about this, like, this money is invested with a long-term perspective, right? We have obligations we need to meet on a quarterly and annual basis, whether we're talking about the pension side or on the retiree healthcare side. But I was thinking about this as we wrapped up the retiree healthcare comments. You know, as I look at this, so the S&P is down 20% on a year-to-date basis. Okay, in the last 6 months, it's lost 20% of its value. But in the last 3 years, it's up 10%. So from 3 years ago to today, you have 30% more money. Like every $1 million you put in the S&P 500 3 years ago is worth 30% more today. In the last 5 years, even though we're down 20% in the last 6 months, the last 5 years, which includes that 20% decline, the S&P is still up an annualized 11%. So every $1 million you put, or every dollar you put, whatever that dollar value, right? Every dollar you put to work 5 years ago in the S&P 500 is worth 55% more today. Okay? So every time you zoom out and look at things from a longer-term lens standpoint, yes, we're down 20, we're still up 55% from where we were 5 years ago. So kind of look at investors and say, remember last year when we were talking about 30% numbers for the last year out of the S&P 500? Well, you can't be up 30 if you aren't willing to stomach at times being down 15 to 20 or maybe a bit more. So from an individual results standpoint, sorry, I'll say one more piece in the long term. I always love this chart. It's just a hugely powerful chart. So this measures from April 14 to today, you know, the beginning value of the DB equity portfolio. So this is kind of the decision of, hey, let's bond this and invest the proceeds in the equity market, which in the last 6 months seems like a crazy idea. But for the fact that over the last 8 years and a quarter, so April 14 through June of 22, that $84 million, had we not been invested in the equity markets and just kept this in short-term cash, would have been worth $46 million less. It would have been worth $37.9 million. Today, sorry, at the end of June, this number's higher today, but at the end of June, portfolio is worth $76.4 million. So that's a decline from the peak we had back in December, but the overall experience, right? Every time we zoom out and take a look at things from a bit of a longer term perspective, yes, we're down in the last quarter, in the last 6 months, but over that 8-year time period, the equity market has added $38.4 million in additional value to this portfolio. That's the success of the long-term aspect of an equity portfolio. Yes, we're down 15% in the last quarter, but we're still, over the long term, right, the idea of just take a step back and take a longer-term perspective, this has been wildly successful to very successful and continues to be. So where did we end up? So for the quarter, down 14%. This is the second quarter of the calendar year, but I think it's important to note, specific to the township, it's the first quarter of the calendar year. So we're 3 months in. We've got 9 months to go in terms of what impact this has from an actuarial standpoint. Different conversations with city clients because their June 30 fiscal year ends. Where did it come from? Where did it not? And core was basically a push for the quarter, essentially in line. The S&P 500 index, no surprises from one quarter to the next, right in line. What's interesting, if you look at the concentration in that benchmark, so the S&P 500's 507 names. Top 10 holdings represent 2% of the names, right? 10 out of 500 is 2%. But in terms of market value and contribution, they're 28% of the benchmark. So pretty highly concentrated. Those 10 names were down an average of 25% for the quarter. So they were 6.6% of the 16% decline. Or put another way, 28% of the benchmark was responsible for 41% of the negative performance. Really an outsized contribution. Edgewood underperformed for the quarter. Remember, Edgewood is a 22 stock portfolio. It's always 22, never 21, never 23. I think it's like a 96 or 97% active share? Yes. It looks absolutely nothing like their benchmark. Every name in their portfolio is in the benchmark, but in terms of weightings and how they have that built, it looks nothing like the Russell 1000 growth. They don't own 13% in Apple and Microsoft. If they own it, it's in a smaller position, and I realize it seems odd to say a 22 stock portfolio is more diversified, but if you think about it, 22 names, if that was equal, that would be a 4.5 to 5% weighting in each position, not 13. Impacted as of late by names like Snap, NVIDIA, Netflix, which burned a lot of investors in the second quarter, has helped a lot of investors here in the third quarter as it's rallied back. If we actually go to the back of this, so your performance, your track record with Edgewood hasn't been the most awe-inspiring, but one of the exhibits we have here back at the back of the book, so this is page 12, if you're looking at a hard copy, is a long-term track record for each of these. So Edgewood's track record dates back to the mid-'80s. Minimal change in team, but this is the 10-year track record for the mutual fund that you own. And look, for example, at the 10-year number. 10-year number up 14.3. Interestingly enough, they lagged their benchmark. The benchmark for that time period was up 14.8%. They ranked in the 13th percentile, so they outperformed 87% of their peers. That includes the difficult performance in the last 3 to 12 months. So moral of the story here is they've gone through this before. They'll go through a period like this again because they look absolutely nothing like the benchmark. But history has rewarded Edgewood has rewarded patient investors. This is also why it's one piece of the overall portfolio, right? It's not the only U.S. equity exposure. It's balanced within Cora's portfolio and balanced with Fidelity with that S&P 500 index fund. Remember difficult conversation in the last couple of meetings about Clarkston, right? Underperforming. Huge swing in performance. There's two things that jump out at me on this page. Down 7.5 for the quarter versus benchmark down 17. Dave, I know I promised I'd change the jokes, but I can't because it works. It was beer, food, and financials that helped them. Cisco, Molson, Post Holdings, and LPL Financial was a contributor to performance for them for the quarter. What I found most interesting is, in the last year, they're down 8.6%, benchmark's down 21, so they're 13% ahead of their benchmark, right? Somebody still beat them. They ranked in the 2nd percentile. Someone still had a better track record in the last year than that portfolio. But absolutely great there from a protection standpoint. Remember, they're half the component of the small mid-cap allocation. They're balanced with that Fidelity Extended Market Index Fund. That index fund crushed it last year in a bull market and has taken it on the chin so far this year, just as markets have pulled back. Now, I'll tell you here in July, at the risk of taking away some of the success of Clarkston rewarding your patients, Clarkston's lagging in this rally we've seen in July, and that Fidelity Extended Market Index Fund is actually outperforming as a number of the tech names in that portfolio or in that index fund are rallying off their lows. From an international standpoint, Oakmark outperformed as we'd expected, right? Value portfolio, really focused on high quality companies, 75 names. Interesting commentary for them. So 30-year history. Right, they track how their portfolio trades versus what they believe the intrinsic value is, right? So what's our price target versus what do we own? What's our price target versus where is it trading at right now? At market peaks, and this is indicative of a value portfolio, at market peaks, it usually trades as high as 80% of their intrinsic value. Right? If it were a growth manager, that number would be over 100%. But remember, they're focused on buying good quality companies at an attractive price, so there's a margin of safety there. So market peaks, it usually trades at about 80%. Market lows, think maximum stress. March of 09, think March of 2020, trades at 35%. Today it's at 50. It's a pretty attractive entry point from a portfolio standpoint. Fidelity International Index, no surprises, down 13 and change. I don't know if I mentioned this before. From an international index fund standpoint, you're always going to see a bit of outperformance or underperformance. Passive investing from an international standpoint is a horseshoes and hand grenades approach, right? Close counts. You cannot fully replicate that index, so they take a sampling approach. right? And they go down, you look from a sector standpoint, will match, from a subsector standpoint, from an industry standpoint, and they work their way down. But there are flat out names that they just can't own because they would have a controlling interest in that company, or there aren't enough shares available to trade for them to have a position. So it looks like the index, but it's as close as you can possibly get to give you as much diversified exposure as possible. Finally, rounding out the traditional equity portfolio, JP Morgan with their emerging markets. Seems odd to say that EM was one of the best performers for the quarter. That was a bit of a surprise. A lot of that's just based on US dollar strength. Down just over 10%, so about 1% ahead of their benchmark. Interestingly, it's a lot of consumer names. You know, JD.com, which would be the second largest Chinese e-commerce company, Yum China, and the Unilever of India. So a bit of a change from a consumer standpoint. Finally, from a real estate standpoint, fabulous addition to the portfolio. Principal is the only piece that's priced so far. TerraCap pricing probably in the next week or so, which we'd expect to be positive.
4.5.
4.5?
Yeah.
Okay.
Higginbotham emailed me back last night.
Perfect.
Positive 4.5.
So good to see this change, right? The idea of decoupling all of the performance from the portfolio away from, is the market up or is the market down? So Principal with their enhanced property fund, remember that's the portfolio that was added, broadly diversified across the U.S. by geography and by property type. Up 5 and change for the quarter, and since it was added back in February, up 13%, so just a great addition to the portfolio so far for this year. And then TerraCap, which is going to be, again, private real estate, but it's a closed-end fund, right? Put our money to work, and then it is returned to us based on when they sell underlying properties. You can wave your hand and raise it and say, I want my money back, and there isn't the redemption options like there are with Principal. That was intentionally done, so we match some liquidity with illiquidity. So the since inception number is more of a measure, and it's less of a how does it focus versus benchmark, and really a, look, we're expecting a kind of 13 to 15% return and out of the gate. So that one was funded back in May of 21, so a little over a year in, but it's now in positive territory. Was up 9. That number is now going to be closer to 12 to 13% based on the estimate that we just got in the last 24 hours from them. So again, good news there from a real estate standpoint. It's always nice to see a new addition to a portfolio work, right? We talk about the merits of it, and then have it allocated and then have it generate positive returns is always an encouraging sign. So I'm going to end on a high note, right? The latest changes to the portfolio were accretive to performance, and I'll pause there and see if there's any questions.
I have a question. Brian, you mentioned the S&P 500 index. I believe you said 10 of the 500, 28% concentration and 41% of negative performance. So from my standpoint, I guess I've never realized that or heard that before. So it's not as diversified as someone may assume, being that it has over 500 names in it.
Yeah, think about it. You have 490 names that make up the remaining 72% of the benchmark. And a lot of those names are going to be 0.1%, 0.05%. Because there's a big, you've got multiple names north of $1 trillion in value and a whole bunch of names at 50 billion. And 50 billion seems like a pretty big company think by every measure, that's a big company. But 50 billion versus $1 trillion is a huge dispersion. The concentration in the Russell 1000 growth is even bigger. The top 5 holdings in that benchmark represent 35% of the index. So that's where it's given large cap growth managers have just had a fit of trying to outperform the benchmark. But the thought of going passive right now in large cap growth scares me more than the idea of saying I'm going to buy more of the S&P 500, because by that definition, the S&P is a more diversified benchmark than the Russell 1000 growth is. And the last time we were this concentrated on the large cap growth side was in the late 90s. And the next decade, I think it was like 75 or 80% of active managers outperformed in the large growth space. So
Concentration higher than it was in 99.
yeah, it was 28% in 99, and it's 35% today in the Russell growth.
I wrote that down, Jason. It's just, that's why we went active and passive
Yep.
blend, because volatile times like this, active managers can get a little bit more diversified or defensive.
Yep.
Where the index, when it's running straight up, is easy, right? But when it starts going down, it's like catching a falling knife.
Yeah, and look, there's been a bit of rebalance activity at the, I'll call it at the global level, right, in terms of overall portfolio moves. But there's been a tremendous amount of rebalancing activity going on inside of the individual active managers. You know, they've been selling, look, anything housing related, particularly anything housing lending related, moved out of late last year and shifted into things that were more, look, businesses that can directly pass on inflationary costs to their end consumer, right? So let's move away from record high in housing and record high in lending volume, right? We've made as much money as we can possibly make. I'd rather leave some on the table and be wrong and shift into, you're seeing value managers, we're talking about, you know, there are tech companies, and think not semis, but, or semis, but service, right? So contract service revenue that have been trading at 20 to 25 times earnings that they've loved, but can just never, I can't buy this as a value manager. It doesn't, right? I'd get fired. Like literally, we'd fire them tomorrow for buying a stock because it completely violates their discipline. It's now in the portfolio because it's trading at 5 to 6 times forward earnings. So they're selling names, they're trimming names that have held up, you know, down 10, 15, 20%, and buying names that are down 70 to 80 in the portfolios. So there's been a lot of that activity inside of Clarkston, Ancora, Oakmark, just in terms of selling quality and buying what should be quality going forward.
So so I assume then in our overall strategy of what we have here, knowing what you know and you're tracking the concentration of those index funds, overall we're diversified, and if you felt that because that concentration changes, you would come back and suggest a change.
Absolutely, absolutely. And that's why you're overweight active versus passive right now, and have been for a while, and have had a value bias to the portfolio versus growth. And it's helped.
Any other questions?
Curious, Brian, do you know what percent Clarkson's holding in cash? Just off the top of your head, sorry for the detailed question, but
cash, don't they?
In a market like this, they have a tendency to deploy it pretty quickly. Their problem as of late has been names being taken, either acquired or taken private. If we had like Jeopardy theme music playing, I think it would it would end the. Actually, right now they're at 12%,
interesting.
which is up from 5 or 6. Yeah. Look at recent transactions. I would have expected that number to be lower.
Right.
Well, the good news is in the history of the United States, the market's always recovered. It's just a matter of when. We'll be back up there someday.
They just sold a full position in CDK in July, like in the last 2
Okay.
weeks. So that would have generated that cash balance for them. So before that, they would have been sub 4, which for them is as bullish and as fully invested as you can possibly get.
Interesting, thank you.
Yep.
Then, one quick thing for my,
Yeah, I was going to do it under new business, but you can, I guess that's a little.
This is on him,
Oh,
too. This is on
Okay,
him.
I wanted to follow up question you had.
when do we talk about Edgewood? I know we talked about with Clarkston, we started looking at them, and they came in, and obviously they've now shown their worth. Edgewood, even when you go back to their long-term data, has been on the downside for 5 years until you look at 7 years. When do we have the discussion or put them on the watch list to find a new position for them?
I don't think it's the time to find a new position. I think this might be the time to add to it. Let me come back at the next meeting, and we'll do a longer-term review and show you when this has happened before and what the recoveries look like. Like, let us show you why we still have confidence in the organization and answer the question that way.
Perfect. Any other questions? Thank you. Any new business? Under, yeah. go ahead.
So, in our first meeting this year, Schwartz came in and proposed a couple changes to our DB plan for taking some names off and putting some names on. I know we had tabled it. They said we could look at that suggestion. I don't know if we want to talk about it more, look at those names, or have them come in and make their final recommendations. But do you remember that was the meeting that Mr. Potosky was not here? So I just want to know if we're going to make a ruling on that.
If you'd like, we can have them come in next time and just update on where we're at with that.
That'd be great. Thank you very much.
Yep,
Okay.
on the DC plan.
DC, excuse me, I said DB, I apologize.
That's okay.
Dave, I just want to make a comment. Last time as well, we discussed MIFL requirements on the DB plan, and as well as every December, we have to make our actuarially determined contribution. So in May, we actually combined those, so we met our MIFL requirement by making our ADC payment in May instead of December, of just shy of $5.1 million.
Okay. Anything else? Any other new business? No? All right, meeting adjourned.